Stocks, also known as equities, are among the most fundamental components of modern finance. They represent ownership in a company, allowing investors to participate in both its successes and risks. When an individual buys a stock, they acquire a portion of the company, known as a share, and in doing so, they become part owners of the business. Stocks are issued by companies to raise capital for a wide range of purposes, including expansion, research and development, acquisitions, and working capital needs. Unlike loans, which require repayment with interest, stocks allow companies to secure funding without increasing debt obligations. This unique feature has made stocks a cornerstone of modern corporate finance and a central driver of economic growth. Stocks come in different forms, most commonly as common stock and preferred stock. Common stock provides shareholders with voting rights and, in many cases, dividends, which are distributions of company profits. Preferred stock typically does not carry voting rights but offers fixed dividend payments and priority over common stockholders in the event of company liquidation. Each type serves different purposes for companies and investors, creating a diverse financial ecosystem that accommodates various risk appetites and investment goals. Stocks are primarily bought and sold on stock exchanges such as the New York Stock Exchange, NYSE, or the Nasdaq, although private companies may also issue shares through private placements. The stock market functions as a platform where investors can trade ownership in companies, providing liquidity, transparency, and price discovery. The prices of stocks are determined largely by supply and demand, influenced by company performance, economic conditions, and market psychology. If a company demonstrates strong growth, profitability, or innovation, demand for its shares often rises, pushing prices higher. Conversely, poor performance or negative news can lead to declines in stock prices. Investors rely on both fundamental analysis, which examines a company's financial statements and business model, and technical analysis, which studies historical price movements, to make informed decisions about stock purchases and sales. Stocks in finance. Stocks play a central role in finance by bridging the gap between companies that need capital and investors who seek returns. For companies, stocks provide an avenue to raise equity capital without incurring debt. Unlike bank loans or bonds, which must be repaid with interest, issuing stock transfers a portion of ownership to investors. These investors, in turn, expect returns through either dividends or increases in the market value of the stock. Equity financing enables companies to pursue ambitious projects that might otherwise be too risky or capital-intensive, such as entering new markets, developing cutting-edge technologies, or expanding production capacity. For individual investors, stocks represent one of the most important tools for wealth creation. Historically, equities have delivered higher long-term returns than most other investment classes, including bonds, savings accounts, and commodities. While they come with higher risk due to market volatility and company-specific uncertainty, stocks provide opportunities for both capital appreciation and passive income through dividends. By participating in the stock market, individuals not only grow personal wealth but also indirectly contribute to economic growth, as their investments provide the capital companies need to expand and innovate. Liquidity is another critical function of stock markets. Investors can quickly convert shares into cash, allowing for flexibility in portfolio management and the efficient allocation of capital. This liquidity ensures that capital is directed toward companies and industries with promising growth prospects, promoting productive use of resources. Furthermore, stock markets act as mirrors of economic health, providing real-time insights into corporate performance, market sentiment, and broader economic trends. Rising markets often reflect investor confidence and expectations of economic growth, while declining markets may signal caution or impending economic slowdowns. Stocks also enhance corporate governance. Shareholders, particularly those holding significant positions, have voting rights that allow them to influence key decisions such as mergers, acquisitions, and executive compensation. This accountability helps align the interests of management with those of investors, promoting operational efficiency and strategic foresight. Stocks and the economy. The economic significance of stocks extends well beyond individual finance. By facilitating capital formation, stock markets stimulate investment, innovation, and economic growth. When companies raise funds through equity issuance, they invest in infrastructure, research, and human capital, which generates employment and boosts productivity. For instance, a technology company issuing shares to develop a new product can create jobs for engineers, designers, and marketers while contributing to the economy through increased output and taxation. Stocks also promote entrepreneurship. Entrepreneurs can access public markets to fund innovative ideas, reducing reliance on debt financing and minimizing financial risk. This encourages risk-taking and experimentation, which are essential drivers of technological advancement and economic dynamism. Stock markets also facilitate efficient resource allocation. Capital tends to flow toward businesses with the most promising prospects, enabling productive companies to grow and scale, while underperforming enterprises struggle to attract investment. This mechanism ensures that resources are allocated based on potential economic value, enhancing overall productivity. Beyond capital allocation, stock markets act as economic indicators. Stock indices such as the S&P 500, Dow Jones Industrial Average, and Nasdaq Composite serve as barometers of market sentiment and economic expectations. Rising indices signal investor confidence, which often correlates with higher consumer spending and business investment, while declining indices can reflect uncertainty or recessionary trends. Stock markets also encourage long-term savings and investment. Retirement accounts, pension funds, and mutual funds invest heavily in equities, channeling household savings into productive investments that support economic development. Globally, stocks facilitate cross-border investment, connecting economies and allowing capital to flow to regions with higher growth potential. International investors can buy shares in foreign companies, diversifying risk while supporting global economic integration. This international dimension not only enhances capital allocation efficiency but also strengthens global financial stability, as economic growth becomes interconnected across borders. Risks associated with stocks. While stocks offer many benefits, they also carry inherent risks. Market volatility can cause sharp fluctuations in prices, influenced by economic, political, or company-specific events. Business risk exists because companies may underperform or fail, potentially resulting in total loss for investors. Speculative bubbles, in which stock prices exceed their intrinsic value, can lead to dramatic market corrections, as seen in historical episodes like the 1929 stock market crash and the 2008 financial crisis. Prudent investing requires strategies such as diversification, long-term planning, and careful research to mitigate these risks. Regulatory frameworks play a crucial role in protecting investors and maintaining market stability. Agencies such as the U.S. Securities and Exchange Commission, SEC, enforce transparency, accurate reporting, and fair trading practices. Without such oversight, stock markets would be vulnerable to manipulation, eroding investor confidence and threatening economic stability. Advanced uses of stocks. Stocks are not merely instruments of ownership, they underpin more complex financial strategies and innovations. Derivatives, including options and futures, derive their value from underlying stocks and provide mechanisms for hedging risk or speculative gain. Companies use derivatives to protect against fluctuations in stock prices, interest rates, or commodity costs, while investors leverage these instruments to manage portfolio exposure or enhance returns. Institutional investors such as mutual funds, pension funds, and hedge funds play a central role in stock markets. Managing large pools of capital, they influence market trends and corporate governance, often engaging with company management to ensure strategic decisions align with investor interests. Institutional investment contributes stability by absorbing market shocks, though large-scale shifts in their holdings can also exacerbate volatility. Mechanisms like stock buybacks further illustrate the strategic use of equities. When a company repurchases its own shares, it reduces the number of outstanding shares, which can increase the stock price and signal confidence in the company's future. Dividends remain an essential tool for distributing profits to shareholders, incentivizing investment, and sustaining market participation. Behavioral economics and market psychology. Stock prices reflect both fundamental performance and investor psychology. Emotions, biases, and herd behavior often drive short-term price movements. Investors may overreact to news, underreact to long-term trends, or follow the crowd, creating bubbles or market crashes. Behavioral economics studies these patterns, offering insights into why markets sometimes deviate from rational expectations. Understanding these dynamics is essential for both investors seeking to optimize returns and regulators aiming to reduce systemic risk. Market psychology also has tangible economic effects. Rising stock markets can boost consumer confidence, encourage spending, and stimulate investment, while declines may trigger caution and reduced economic activity. In this sense, stock markets act as both a mirror of economic sentiment and a lever for influencing broader economic behavior. Stocks and technological disruption. Technology has transformed how stocks are traded, analyzed, and regulated. Electronic trading platforms replaced traditional floor-based exchanges, enabling rapid execution and global access. High-frequency trading algorithms process millions of trades per second, creating new opportunities and challenges. Artificial intelligence and machine learning are increasingly used to forecast trends, optimize portfolios, and detect market anomalies. These innovations improve efficiency but also raise regulatory and ethical questions. Algorithmic trading can amplify market volatility, and unequal access to advanced tools may favor institutional over retail investors. Nonetheless, technology continues to democratize market access, improve transparency, and enhance analytical capabilities for investors worldwide. Stocks and wealth distribution. Equities play a critical role in wealth distribution. Stock ownership is often concentrated among higher-income individuals and institutional investors, contributing to wealth inequality. However, broader participation through retirement accounts, mutual funds, and exchange-traded funds allows households to build wealth over time. Expanding access to equities promotes financial literacy, long-term planning, and inclusive economic growth. Well-designed policies and education initiatives can empower more individuals to benefit from stock market participation, fostering equitable wealth creation and reinforcing economic stability. Stocks and long-term economic resilience. Stocks contribute to economic resilience by enabling flexible corporate financing. Companies with access to equity capital can weather recessions, pivot strategies, or invest in innovation during challenging periods. Investors can diversify portfolios to mitigate risk, while capital flows efficiently to emerging sectors. This adaptability is critical in economies facing technological disruption, climate change challenges, and global competition. By facilitating resource reallocation, stocks support structural economic change. As industries decline, capital shifts toward high-growth sectors, promoting efficiency, innovation, and sustainable development. In this way, stock markets act as engines of long-term economic adaptability and resilience. Stocks and societal impact. Stocks influence society beyond financial outcomes. Successful companies create jobs, provide goods and services, and drive technological progress. Publicly traded companies must disclose performance, governance, and strategy, promoting transparency and accountability. Moreover, the growth of socially responsible and ESG investing shows that stock markets can encourage ethical and sustainable corporate behavior. By aligning financial incentives with societal goals, stocks help foster a more equitable, responsible, and sustainable economy. Conclusion. Stocks are more than mere financial instruments. They represent ownership, a pathway to wealth creation, and a mechanism for corporate growth. They underpin advanced financial strategies, reflect investor psychology, and shape global capital flows. Stocks stimulate innovation, reward entrepreneurial risk-taking, and contribute to long-term economic development. While stocks carry inherent risks such as volatility, bubbles, and concentration of wealth, they remain indispensable to modern finance. Effective regulation, education, and broad access can ensure stocks benefit investors, companies, and society alike. They connect capital-seeking businesses with capital-providing investors, influence economic policy, and drive technological progress. In essence, stocks are engines of innovation, growth, and societal advancement. They integrate personal finance, corporate strategy, and economic development into a dynamic system that sustains prosperity. Understanding stocks, their mechanisms, risks, and societal implications allows investors, policymakers, and citizens to harness their full potential, ensuring that stock markets continue to drive financial growth, social progress, and global economic stability for generations to come. Pros and cons of stocks. Stocks, also known as equities, are financial instruments that represent ownership in a company. They are a cornerstone of modern finance, offering both opportunities and risks to investors. Understanding the advantages and disadvantages of stocks is critical for individuals, institutions, and policymakers, as stocks not only impact personal wealth but also shape corporate growth, market behavior, and economic development. Pros of stocks. One of the primary advantages of stocks is their potential for wealth creation. Historically, equities have offered higher long-term returns than most other investment classes, including bonds, real estate, and savings accounts. While bonds provide fixed interest payments and savings accounts offer minimal returns, stocks allow investors to participate directly in the growth and profitability of companies. Through dividends and capital appreciation, investors can build substantial wealth over time. For example, an investor who purchased shares in a technology company during its early growth phase may see exponential gains as the company expands and innovates. Another significant benefit is the liquidity that stocks provide. Unlike real estate or some alternative investments, stocks can typically be bought and sold quickly on exchanges, allowing investors to access cash when needed. This liquidity ensures flexibility in portfolio management, enabling individuals and institutions to adjust their investments in response to changing financial goals, market conditions, or emergencies. Stocks also contribute to diversification, a key strategy in risk management. Investors can spread their capital across different companies, industries, and regions, reducing the impact of poor performance in any single investment. Diversification helps stabilize returns over time and protects investors from catastrophic losses if one company or sector underperforms. This makes stocks particularly useful in long-term investment strategies, including retirement planning and wealth preservation. Ownership of stocks also provides a sense of participation in the economy. Shareholders can influence corporate governance through voting rights on major decisions, including mergers, acquisitions, and executive appointments. This accountability mechanism encourages companies to operate efficiently, transparently, and in the interests of investors. Beyond individual benefits, this participatory nature contributes to the broader economic ecosystem by promoting responsible corporate behavior. From a macroeconomic perspective, stocks facilitate capital formation, which is essential for economic growth. Companies issue shares to raise funds for research, expansion, infrastructure, and innovation. By channeling funds from investors into productive use, stocks support job creation, technological advancement, and overall productivity. Furthermore, stock markets act as indicators of economic health. Rising stock prices often reflect investor confidence and optimism about economic prospects, while falling prices can signal caution or potential slowdowns. This dual role as a wealth-building tool and economic barometer underscores the centrality of stocks in modern finance. Stocks also provide opportunities for income generation through dividends. Many companies distribute a portion of profits to shareholders, creating a steady stream of passive income. Dividend-paying stocks are particularly attractive to long-term investors seeking to supplement income, plan for retirement, or reinvest dividends for compounded growth. Additionally, stocks are highly adaptable financial instruments, forming the basis for other investment vehicles such as mutual funds, exchange-traded funds, ETFs, and derivative products. These instruments expand access to equities and provide further options for risk management and strategic investment. Cons of stocks. Despite their many advantages, stocks carry significant risks that investors must carefully consider. One of the most prominent disadvantages is market volatility. Stock prices fluctuate constantly, influenced by factors such as company performance, macroeconomic conditions, geopolitical events, and investor sentiment. Sudden drops in stock prices can result in substantial short-term losses, making stocks unsuitable for individuals who require guaranteed or stable returns. While long-term investment can mitigate volatility, short-term investors, or those nearing retirement, may be particularly vulnerable to market swings. Another risk is company-specific performance. Stocks are tied to the fortunes of individual companies, meaning that poor management, declining revenues, or unforeseen crises can severely reduce the value of shares. Unlike bonds, which promise fixed interest payments, stocks offer no guaranteed returns. If a company goes bankrupt, shareholders may lose their entire investment. This risk is amplified for investors who concentrate their portfolios in a small number of stocks rather than diversifying across multiple assets. Stocks can also be affected by speculative behavior and irrational market dynamics. Investor psychology often drives price movements beyond what fundamental company performance would justify. Phenomena such as herding behavior, overconfidence, and fear can create bubbles and crashes. Historical examples include the dot-com bubble of the late 1990s and the 2008 financial crisis, both of which resulted in widespread financial losses. Speculative volatility introduces systemic risk, where declines in one sector or market segment can spill over into broader financial markets and even affect the economy at large. Additionally, the complexity of stocks and the broader equity market can present challenges for novice investors. Understanding financial statements, company strategy, market trends, and valuation metrics requires knowledge, research, and time. Without adequate education or guidance, investors are susceptible to poor decision-making, which can result in underperformance or losses. Fees and transaction costs associated with trading stocks or investing through funds can further reduce net returns, particularly for frequent traders or those using active management strategies. Economic and geopolitical factors also contribute to the risks of stock investment. Global recessions, interest rate hikes, inflation, political instability, and trade tensions can lead to declines in stock prices regardless of a company's individual performance. Investors are therefore exposed to both micro-level company risk and macro-level systemic risk. Currency fluctuations can additionally affect foreign investors, adding another layer of complexity for international portfolios. Another disadvantage relates to wealth inequality. Historically, stock ownership has been concentrated among higher-income individuals and institutional investors, meaning that the financial benefits of equity markets are not evenly distributed. While programs such as retirement accounts, ETFs, and public mutual funds have expanded access, many individuals remain underrepresented in equity ownership, limiting the democratizing potential of stocks. Unequal access can amplify disparities in wealth accumulation, particularly over long periods of compounding growth. Despite these risks, stocks remain essential tools in both personal finance and broader economic systems. Investors can mitigate disadvantages through careful diversification, long-term planning, education, and risk management strategies. For instance, a balanced portfolio might combine stocks with bonds, real estate, or commodities to reduce overall volatility. Regular monitoring of company performance, staying informed about macroeconomic trends, and disciplined investment strategies further improve outcomes. For companies and the economy, stocks are indispensable for raising capital, encouraging innovation, and promoting efficient allocation of resources. While investors face risks, the collective participation in stock markets drives economic growth by funding entrepreneurship, technological advancement, and infrastructure development. Regulatory frameworks also play a critical role in mitigating risks, ensuring transparency, protecting investors, and maintaining market integrity. In the end, the pros and cons of stocks reflect the balance between opportunity and risk. Stocks offer potentially high returns, liquidity, diversification, income generation, and a means to participate in economic growth. However, they carry volatility, company-specific risks, market speculation, and unequal access. Understanding both sides is crucial for anyone engaging with equities, whether as an individual investor, institutional participant, or policymaker. By leveraging the benefits while mitigating the risks, stocks can serve as powerful instruments for wealth creation, financial planning, and economic development. In summary, stocks are a double-edged sword. On one side, they are powerful engines of growth, offering wealth accumulation, corporate financing, innovation, and global economic integration. On the other side, they carry volatility, potential losses, and systemic risks that demand careful management. The interplay between these advantages and disadvantages makes stocks a central, dynamic element of modern finance, one that requires knowledge, strategy, and vigilance to navigate successfully. When approached wisely, stocks empower individuals, drive corporate growth, and fuel economic development, highlighting their indispensable role in the financial landscape. Awareness of both pros and cons allows investors to make informed decisions, ensuring that stocks remain effective tools for personal wealth creation and broader societal progress. Thank you for watching this video.